Adrian, good morning. Always a delight to have you back on ET Now. Adrian, suddenly the world is looking like a broken down place. European problems have come to fore again. US economic data has been mixed, and China is threatening to slow down further. How would you characterize the current market environment?
Yes, I mean, we really had a perfect storm last week. We started off with bad employment data. We followed that through with elections in Europe. I think the French election was absolute consensus. The problem was in Greece, where we failed to form a new coalition, and that's generating a lot of concern about the direction of Greece, particularly whether it stays within the euro. We obviously had a trading loss with one of the big banks. And in Brazil, we had some very bad inflation numbers, and then we finally finished the week with poor data out of China. I think all of that going on, it's easy to forget some of the good variables that are going on at the moment. The oil price is coming down. We see 2012 being quite different from 2011. In 2011, we had a serious inflation problem in both the developed and the emerging world. Inflation looks very benign, and we see real income growth remaining quite healthy in the United States, and that end demand stays on track. And we've got a lot of confidence with our US GDP number. With regards to Europe, a year ago, the ECB was fighting inflation. It raised interest rates in April and then again in July. This time round, the ECB is very focused on ensuring liquidity within the European financial system, and we think the threat of a liquidity tail risk is much lower in Europe. And finally, in the emerging world, we were also fighting inflation. Broadly, inflation has come down, and we have seen some easing in policy, so an acceleration in the second half seems reasonable. So my conclusion on what's happened is to take this as an opportunity to add equity risk, as the fundamentals are different in 2012 relative to 2011.
Moody's just came out with a statement saying that they believe there's rising risk of Greece defaulting right now, given the election revolt that's happening there, and also its exit from the Eurozone. How do you think that event would play out, if it does?
Okay, well, first of all, Greece in itself isn't that important. We're now less than 2% of euro area GDP, less than 2% of euro area debt. The question is, does this lead investors to say Spain might be next, Portugal might be next? And this is where you need to go back and look at what the ECB is doing. I don't think Spain or Portugal will be next, and I think the ECB has sufficient firepower to prevent contagion. But that ultimately is a judgment call. It is quite possible that markets sell off further because they worry about this.
Adrian, do you think the consensus for a market like India is too bearish and it's a one-sided trade given the way how rupee has moved or how macro fundamentals have moved for India?
Yes, I think there's a lot of bearishness on India. People are extremely frustrated by the tax situation, very concerned about political stability, and this sort of discouragement of foreign investment in a country where the current account deficit is causing the rupee to be relatively weak. But if we look at some of the positives, we actually think the Indian economy is weak. We believe the inflationary pressures should be moderating. The RBI has eased policy. The rupee has corrected, which should also be a stimulus. And as I was mentioning earlier, the oil price is coming down. So within India, we do like the financials. We think there's probably some option value in some of the engineering construction companies, which are valued for almost zero growth at this point. We have seen good performance from some of the auto names already, but we still think they offer some value.
Do you think that the 6 to 7% average holding that India has in emerging market portfolios and that underweight stance could slowly start changing? As you pointed out, most of the negatives are known, and over a period of 3 to 4 months may get priced in. So by the end of the year, do you believe that the stance on India would start changing?
Well, it's difficult to comment on that. There's a lot of event risk still in India, despite the government's efforts to try and clarify what's happening with GAR. That wasn't successful last week. The coalition is still relatively precarious, and as of now, we're not seeing the headline inflation number coming off. I think for India to perform well, we would need to see headline inflation coming off further, maybe some additional easing from the RBI, and we do need this clarification on the tax situation.
Adrian, unfortunately, Indian markets are still reliant on global liquidity. And at a time when global risk off has started, do you think it will be difficult to make an assumption that in the second half of this year, foreign institutional investors, they will continue to invest in India?
So my view on this current risk-off environment is it will be relatively short-lived because the fundamentals, particularly in the US, are stronger than currently priced into markets. And if that occurs, then I do believe people will be interested in EM risk if they're finding the underlying growth stories fundamentally attractive. And I think that's where we get back to the policy issues in India. I mean, much of what's going wrong with India could be fixed with some clearer policy, with less ambiguity over taxation, and with maybe the government taking some longer-term decisions rather than short-term politically expedient decisions. You know, if you get those conditions together, then I think India will attract capital. But we need to get those conditions, and as of now, we don't have them.
Right. You said that you like financials, engineering and construction companies in India. From the financial segment, what interests you more, the private sector, the state-owned banks, where there is some value emerging even though there are concerns on asset quality? And on the construction of the engineering side, again, you know, how are you going about selecting stocks?
Yeah, so for financials, the preference is the private sector banks, where I think the credit quality issues are less severe than in the PSU banks. And in the engineering space, it's focused more on those that have, less exposure to thermal coal power stations, etc., where there's been some policy issues.
Adrian, so what is the red flag for India?
Well, I think I've already been talking about the red flag for India. India has a policy structure that's unhelpful for medium to long-term growth, and that is discouraging investors from going into the market. It has a issue with high inflation, which is partly a function of the inability to get infrastructure projects approved, and these bottlenecks are holding back growth. It also runs a large current account deficit, so is extremely sensitive to where the oil price is.
Right. Also, your view on the currency situation, you talked about it briefly a little while back, but how do you map the levels that the rupee would perhaps trade in, coming closer to its high of, actually its low of 54.30?
Yeah, I think the rupee is moving into a period of higher volatility, probably moving between the 55 and the 48 range. And it's very, very sensitive to whether people are willing to take on Indian rupee risk. And so you could get some better announcements from the government, slightly better economic data, and the rupee would start to trade up to the 50s level or even through that. Or you could get a bad policy decision and perhaps you break down. The currency is extremely sensitive to capital flows, and those are sensitive to macro data as well as policy.
Adrian, so for investors who are sitting on the sidelines and they're sitting on reasonable amount of cash, how should they approach Indian equities? Buy right now, start nibbling in, it's a good time to start accumulating?
Well, it depends where the investors are based. I think if I was based in India, then yes, absolutely, where there's value in the markets, you should be buying. I think for the international investor, they're tending to find markets like the US having a clearer investment story and taking on EM risk, particularly risk in a place like India, does not look that compelling relative to the risk-reward profile of the US equity market.
I want your opinion on two more sectors, Adrian, because, given what's happening with the currency, there has been a lot of focus on export-oriented sectors like healthcare, pharmaceuticals, and technology. How would you approach these two sectors?
Well, the pharma sector in India is very small and has historically been much more selling into the domestic market. I think with regards to the IT sector, we're seeing a dispersion in the underlying business trends across a couple of the big IT names. So it's become a bit more of a stock selection story. But the thesis of being long Indian IT because they're beneficiaries of the weak rupee is a good one, but just make sure you buy the stocks that are executing well.
Adrian, why do you think Indian consumer stocks are outperforming? Lack of options?
Well, there are a couple of sides to this. One is the consumer staple space, which give you a steady growth stream, which is attractive. You have to pay up for it. And then the other side of it is if we're going into an easing cycle with the RBI cutting rates, then that's typically good for consumer discretionary names. And you've seen auto companies performing well, although one of those auto companies is also a beneficiary of a weak rupee and that it has a large production base offshore.
Adrian, I remember exactly a year ago, your big call was to protect capital, hide in cash, and that call worked like a charm for you. So good call, thank you for that call. But my follow-up question is, what is Adrian Mowatt's big call for FY13 or for rest of the calendar year 2012?
Well, I think there's a lot of money to be made in equities relative to other asset classes, but our preference is actually for the US equity market. Then within emerging markets, we want to be long tech hardware. We like some of the smaller markets, such as the ASEAN region, where you can buy into exposure to domestic demand. We like selected consumer stocks. And we think through having a big dispersion of exposure at the sector level rather than the country level, you can generate outperformance. And we would see emerging market equities performing in line to maybe marginally lagging the US equity market.
Right. Adrian, you spoke about the inflation situation with emerging markets and how it is benign compared to last year. We are coming out with our inflation data a little later today. How do you map the concern on inflation for India especially?
Yeah, so, we've had relatively sticky inflation in India. It hasn't been coming down maybe as much as the weak economy would suggest. But in discussing the situation with corporates, pricing power is relatively weak at the moment, and it seems reasonable to surmise that inflation will gradually move lower. I mean, obviously we've had a weakness in the currency, but the Indian consumer is somewhat defended from the weaker currency because of price controls. And with the rupee going down, but also the oil price going down, then perhaps the government's fiscal position can cope without changing petroleum product prices at this point in time. And the other thing I would highlight on inflation, if you look at the global agricultural index, so this is agricultural commodities, that looks as if it's about to break into a lower trading range. And we are seeing a lot of stories about how agricultural inventories are higher than original estimates, and that's probably a good sign for inflation globally, including in India.